really begin talking about property, plant, and equipment, okay? First of all, we want to start off making sure we understand where does all of this fit. We have our balance sheet, which is, of course, assets equals liabilities plus equity. We can't get away from this because this is where everything goes. When we talk about our closing entries, they all flow into here. So that's why we continue to go through this same process just a little bit, okay? We have our current assets just for you. Does anybody remember the current assets in terms of how they go? What would be the list of those? What would be the acronym? That means you remember it, okay? So that's good, okay? We're not going to focus on that. There are going to be some things in there, but we're not going to focus on it. We're going to refer to it, but that won't be the focus of this chapter, okay? If we want to compare, which we will, one of them is accounts receivable, which we are labeling as what we did last time, okay? So that's the only reference we'll really make now. But what we're going to be concerned about today is long-term assets. Long-term assets. This is also known as property, plant, and equipment, which is abbreviated PPE, property, plant, and equipment, okay? So, we know that all assets, they increase with a debit or a credit. Do assets increase with a debit? Raise your hand, shake your head. Okay? They don't increase with a credit. So, anything that decreases is going to do it with the credit, okay? So, assets increase with a debit. Anything that decreases them is going to decrease with the credit. We're going to see the same things here. Now, once again, we're focusing on long-term assets, not property, plant, and equipment, we're focusing on long-term assets, not current assets, but I do want to point out one similarity, okay? At this point in time, I'm going to erase this because we're not going to be dealing with this, but I want us to understand where we are. So, we have talked about accounts receivables, and now we're going to talk about property, plant, and equipment. I'm doing this so we'll see the similarities between the two, okay? The similarities. Because they're assets. Because they're assets, they will decrease with the debit, okay? So property, plant, and equipment, we're talking about anything from buildings, machinery, land. Those are going to be our big ones. Buildings, machinery, and land are going to be our major ones we're going to look at in terms of property, plant, and equipment, okay? Buildings, equipment, and land. All of these are going to increase with the debit. Anything that decreases is going to be done with a credit. Now, how do we show a decrease? If you remember last time, for accounts receivables, one way we showed a decrease was with the allowance account, okay? Let me make this a little smaller. We had an allowance account. And the way we showed the decrease was over here on this side, okay? This is the decrease on the credit side, okay? So the credit side decreased. We remember that, right? It was similar to when we talked about revenues. Once we recorded the revenue, we did not touch the revenue. We used another account that was the discount, sales discount or sales return allowances. Well, the same thing we previously did for accounts receivables. We're going to do the same thing now for property, plant, and equipment. We're going to show a reduction in property, plant, and equipment using an account called accumulated depreciation. And in order to have a decrease in that, we're going to go to the credit side, okay? Is that good so far? Now, yes, ma'am.
Is there a specific reason why you changed this to negative signs rather than the plus sign?
I was just about to say that. I did that so we can know that we have a negative here. The small cosmetic thing I'm going to make is that when you decrease accounts receivable, you do so with the allowance. We're good that part, right? A separate concept related. To show an increase, we do an increase in this account with the plus sign, okay? Same here. We increase the accumulated depreciation with the plus sign, okay? But I want us to understand that the effect of this is to reduce assets. That's an excellent question. When you're thinking ahead, you already starting to, even if you're wrong thinking ahead sometimes, it's okay because we want to get those wrong answers out of here, okay? So, just to go back through it again, and I'm not going to put a plus here because obviously we want to keep that, okay? But assets increase with the debit sign. Anything that increases with a debit sign, anything that increases with assets will be done with a debit sign. That would be your accounts receivables. That would be, in this case, our property, plant, and equipment. These are long-term. These are short-term, or as we say, current assets, okay? Anything that decreases will be done with the credit side, okay? It's going to decrease the assets, but it increases the allowance account here. By crediting here, you're going to decrease your property, plant, and equipment. You decrease it by crediting your accumulated depreciation, but overall, it decreases the assets, okay? Is that okay? I'm gonna let it sink in for a second, okay? We're not really rushing. We want to make sure that we get it because it's those foundational things that get us, okay? All right, let me go through it one more time. We're looking at our assets. We previously looked at current assets. Now we're looking at long-term assets, okay? Our long-term assets are going to be here. Last time we looked at our current assets here. But because they're assets, they have similarities in how their accounts behave. That would be anytime the accounts receivable, which is an asset, or the long-term property and equipment increases, it is done so through a debit or credit. Who says debit? Shake your head. Okay? Nobody's saying credit, good, okay? Same thing with property and equipment. Your assets, property and equipment, increase here. So buildings is a type of property and equipment. It will increase with the debit. Machinery or equipment is a long-term asset. It will increase with the debit. We don't show the decrease in this account by crediting the account. We do so with the contra asset account. Contra means against what? Against property and equipment this time, okay? Allowance is a contra asset against accounts receivables. We do so by putting it on the credit side. The credit side of your accounts receivable, the credit side will decrease your assets, but in order to show an increase, we're going to put a positive right here, okay? So that's the difference between those two in terms of why we have two different colors here, which led back to your question. So that's it. Make sure everybody's good with that. That's just like the biggest concept. I think that's kind of weird that may be difficult to get. Can I erase the board? Right, okay. All right. Next, we're going to talk about a slightly different concept, okay? It still has to do with property, plant, and equipment, but I want to talk about a couple of concepts. Still speaking of property, plant, and equipment. We want to understand the difference between things that affect, red is not good, green is not bad, I'm just using different colors here. Things that affect the asset account and things that affect the expense account, okay? Now, if we change the oil in our car, we talk about this, but let's think about this. We change the oil in our car. If we buy a new light bulb for our headlights, every time we get gas, these kind of things, yes, they make the car continue to run as it continues to run properly, but it doesn't really extend the asset the way other things do, okay? For example, if I get a whole new body put on my car, if I get, say if I had a drop top and I get a whole new hood and something, not hood, but a whole new part put on top of it to erase the drop top, that extends the life of the body of that car. If I get a whole new motor, that extends the life of the car, okay? Even changing my air conditioning, that would be more so of an expense because it's not talking about the life of the car. If we think about a building, a nice paint job, Is that going to extend the life of the building? Not really, okay? Now, if we replace the carpet, it's kind of expensive, but we're not talking about how expensive it is. We're talking about how long will it make the building last. If they were to put a little walkway out here, right? Somewhere we can go outside and have class or just sit there and do your work, that's going to extend the life of the building, or it's going to give it a little bit more usefulness of the building, okay? So anything that extends the life of the building or a significant change is always going to result in debiting to increase the asset account, okay? So the asset account is increased when something extends the life of the asset. So the asset account is increased when something extends the life of the asset, okay? And you can write those small examples down that I gave, okay, in terms of a car or a building. Now, if it's just for ongoing maintenance or something like that, then you're going to increase the expense account. You're going to increase this when we have general maintenance, okay? We're going to increase that when we have general maintenance, okay? So, these are things we can think about as we go. Say your car is the company car. So every time you get every time you get gas in your car, you're going to have a maintenance expense, okay? You're not going to have a new asset, okay? Now, if you could somehow get a trailer fused onto your car to serve a different purpose, that would be increasing the asset account. So when you go to your books, you would not ask your person in the office to increase your asset account because you put gas in your car. No, you say, hey, make sure you put this in the expense account. Okay, these are things because you're going to be going. You might not have time to go in and do journal entries. Most of you are not going to do journal entries anymore, and that's okay. But you want to make sure that those who do so know what they're doing, okay? So anything that extends the life of the asset is going to increase the asset account. Anything that is just general maintenance is going to be an expense account. Usually something like maintenance expense or something, okay? Everybody good so far? All right. Next, we're going to talk about, and I'm just giving us an overview of the subjects that we'll cover. We're going to talk about the disposal of an asset, okay? The disposal of an asset. Asset meaning the disposal of something that you bought that is long-term, okay? You don't dispose of cash, but we know what we do with it, okay? Let's just go through this scenario for a second. I only have one item here, and that's going to be a truck. I have a truck, and when I bought that truck, I'm just going to put property plant equipment dash truck because it could be a lot of different things. Property plant equipment truck. Let's just say, how much did I pay for this truck? What's a good price to pay for my truck? $40,000. $40,000, okay? And just, I use your cash to pay it, okay? Use your cash to pay it. Y'all gave me some cash, okay? I use your cash to pay it. Now, we're going to talk about depreciation in a second, but I'm just going to say that over the next 3 years, I had accumulated depreciation of $30,000, okay? We'll talk about depreciation in a second, but over the next few years, I had accumulated depreciation. The way that journal entry looks, which is what we'll talk about in a second, to have that journal entry, what you would have would be a debit to depreciation expense and a credit to accumulated depreciation. Okay, that's what the journal entry would look like. We'll talk about those a little bit more in depth, all right? We know that accumulated depreciation is going to decrease not the value in real life, but first of all, for right now, when I say value, we're only talking about the value on the books, okay? We're not talking about you drove off the lot. That's something totally different. So just to make sure we use the same terminology, for purposes of this example, when I say value, I'm talking about the value that is on the books, okay? It's not talking about this stuff that they talk about when you drive off the lot. That's something else, okay? So for the value, this is going to increase, it's going to, accumulated depreciation decrease the value of that, because anything that decreases the asset is done through a credit, okay? So, when I get ready to sell this truck, I'm going to sell it for cash. So, what should I do? At the very least, we know we're selling this truck for cash. I'm going to debit what? Cash, okay? That's good. That's good. We're going to debit cash. And we still hope to get a little bit more than it's worth, right? So we're going to get, think we get 45 for it? It's in good condition. We can get 45. If we bought this back then, a $40,000 truck now costs about $6,000 about 5 years ago. I promise you it does. I be looking. That's why I know. So I'm not gonna get another one. I'm not gonna get a $6,000 truck to replace a $40,000. I'm not. But we're gonna sell it for $50,000. Okay, that sounds good. $50,000. We're gonna get $50,000 cash. Now, all accounting does is categorizes, right? And all accounting does is just tells us the story of what's going on outside. This tells me that I received cash of $50,000, but I don't know for what. What did I receive it for? For the sale of the truck. The truck had a price here of $40,000. We agree, right? That's what it was on the book. We know that throughout time, we had to accumulate depreciation of $30,000. But right now, I want to make sure that I get this off the books. Why don't you get this off the books? Because if I'm sitting somewhere way away, if you sold all the trucks on your not your car lot, now that's a different story, on your at your place of business. If I'm never there, every time I see assets, I'm like, okay, our company is good. We have a lot of trucks, and so we don't need to worry about investing in that. But if I remove them and I say, oh, our trucks are down, we need to get some more trucks because we're going to see business picking up. So that's the importance of making sure we remove this from our books, because if we don't, somebody, or it may be you may be out in Kansas somewhere doing work, but you need to know what's going on here, and you don't have time to call nobody. It may be 9:30 at night when you get a chance to look at your books. So when you look at your books, you need to make sure everything is correct. If the company sold something, then we need to get rid of it by taking these trucks off the book. Will I take this property, plant, and equipment truck off with a debit or a credit? How would I take it off? With a credit? Okay. All right. So take it off with a credit. This is part of it now. We're going to take it off. Property, plant, and equipment truck. We're going to take it off the books with a credit, okay? So I got all of that out of the way. Got all of that out of the way, okay? Everybody good so far? I have something else. We're going to go into depth about this in a little bit, but remember, over the course of time now, I had accumulated depreciation with a credit. How do I get it? I take a credit off the books by doing a what? A debit. So I have to do the opposite. Remember, when I sell the truck, I sell the tires, I sell the carpet, I sell the light, the front light, the back light, the paint job, I sell it all, right? So when I do the journal entry, I want to get all the journal entries off related to that, right? Because anything left on there is going to tell me a piece of the truck is still there. So I want to make sure I get it all out. I get my accumulated depreciation off by crediting, by debiting accumulated depreciation, okay? And accumulated depreciation was $30,000, okay? So, we're finished, right? That's it. There's nothing else to add. Is that correct? How do we always check and make sure that we're finished our journal entries? Our journal entries, they must do what? Starts with a B. They must balance. That's right. That's exactly right. If they don't balance, then we know something is missing. It could have been that I put a wrong number down. But whatever it is, we have to know that, okay? So that's an excellent answer, okay? Let's think about what we have here. I have a $50,000 truck. Well, yeah, right here. I have $50,000. Okay, on my debits. This is my debit side. And this is my credit side. I have $50,000 credit here. I also have accumulated depreciation of $30,000. And I have a credit over here of $40,000. What does this tell me? Once again, I'm only using the word value as it relates to this. This has nothing to do with depreciation. This is the book value, if you want to say that, okay? So, I had a $50,000 truck. Because it went down a little bit, then that means the value was really what? About $20,000, right? It really was about $20,000. Also, I have over here, I have the truck that I took off the books, but everything's not balancing. So, think about it. We already know that I had a gain on the truck. How I know? Because I got $50,000 here compared to $40,000, okay? We already know that I at the very least got a $50,000 gain, right? I got a $50,000, a $10,000 gain, part of it, right? But remember now, this truck is only worth $20,000. So if it's only worth $20,000, and I got $50,000 for a $40,000 truck, then you know I'm going to have some more gain associated with that, right? So what do I do? Number one, let's remember this right here. Gain, you'll see a account on your books called gain/loss. Gain/loss on sale of your account. That's what you will see, okay? So you can either try to memorize that you always credit gain and always debit loss, or understand that based on the book value of what we have here, then that's what's going to tell me whether I debit or credit. So we know that there's going to be a gain. Gain on sale. I'm going to do this like this because I want to make sure I emphasize what's going on, okay? The gain on sale, we know that $10,000 that came from the actual sale itself, okay? And the difference would be what? If this is $80,000 worth of debits and this is $40,000 worth of credits, then my gain would have to be $40,000, okay? No. 50 plus 30 is 80 minus 40. Should give me 40. $40,000. Write that way. I'm going to make one small erasure mark. Oh, let me change right here. Then I'll have to erase it. That gain is going to be $30,000. Why do I put that? Because I got back everything that lowered the truck, $30,000, and I got the value above that, okay? So together this equals $40,000. This is not two separate things now. This is just showing how we come up with the $40,000. So let's walk back through that. I bought the truck for $40,000. You good with that part? I bought it. I paid cash. That's irrelevant in terms of how we paid because, yeah, and for right now it's irrelevant, but to make it easy, we're going to say we paid cash. Over the next 3 years, I had the book value go down by $30,000 with a credit to that. So when I sell it, I'm always going to debit my cash. We agree with that. I'm always going to debit my cash. Even if I only got $2, I still would debit cash because cash went up by what? $2. Cash is going to be the easiest thing. It's always going to be what it is in your hand, okay? So whatever you get, if you get more or less, you're going to always debit cash for that amount, right? Now, wait, first, are we good with that part? Nod your head there. Okay. Now, accumulated depreciation. We accumulated all that depreciation in a credited account, as we see right here. So to reverse the credit account, the credited account we debited, right, by $30,000. Now, one more time, what does this tell me? Only for the purpose of this, we're going to say value. This shows the reduction in value. We're only using this term right now. We're going to change the word value later, but we understand this shows a reduction in value. That means that $50,000, I understand this is a credit, that's because we're releasing it, but we're reversing it. $50,000 minus $20,000, minus $30,000 will give us $20,000. So our truck is only worth $20,000. Do we see how we come to that agreement? Everybody okay with that? Give me a head. Okay, good. Okay, all right. So our truck is only worth $20,000. Period. Now, I have to get this off the books, and I know how much my truck was worth at first. We already know that we got a gain because we got $50,000 cash, and we got a $40,000. We got $50,000 cash, and we only paid $40,000. So everybody good that we got $10,000 worth of gain at least? Good on that part? Now, where does this other part come from? We not only sold it for 20, we got back 20 plus the 30 we put in, plus an additional 10. So together we got $40,000 of gain on the sale. Okay? And if we just want to look at that one more way, the truck started at $40,000. Okay? When over time it went down by $30,000. Okay? And so at this point in time, it was going to be worth $10,000. Excuse me. Oh, wait, hold on. I think I did something different. Oh, no, I didn't. Okay, yeah. All right, so it's going to be worth $10,000. So when I sold it, when I sold it, I got $10,000 plus the $30,000. $10,000 plus $30,000, okay? I got my $40,000. So if we think of this kind of as a bucket, which that's not a good idea of a bucket, I have to show that I got a $10,000 gain, and I have to show that I also got $40,000 back. I mean, $30,000 back for my accumulated depreciation, okay? So that's in general. We're going to do a real example, but that's just kind of so we can see where we're going with that, okay? When you're looking at, at studying, what you can do is always come back to this one here and say this is just a general example, and then you can apply it to whatever you're looking for. The only difference is if you sold at a loss, let's show it's going to be the same. Even if you sold at a loss, you're still going to debit cash. You're still going to remove depreciation. You're still going to remove the property, plant, and equipment. The only thing is that your difference will be the difference for your gain on sale, which at that time would be a loss if you sold it for less. So let's just say you totally don't understand what's going on here, I know you know this from your first exam. I know you know that from your first exam. I know you know this one from, I think, your second exam or something like that. You'll get 75% of this right, and you may just miss that 25%. So this is really the only new thing that we're going to kind of learn right here, okay? So take it and look at it for a second. Just make sure we don't have any questions, and then we're going to go into another phase there. All right. And you can pretty much just lay that journal entry beside whatever you're doing in terms of sailing, and you're going to pretty much get that, okay? I left at the bottom. I want to make this a little bit better here, okay? This is our bucket that we have here, and we paid $40,000, okay? At the sale date, it was worth $20,000, okay? It was worth, make sure I'm doing it right. It was worth $10,000 because we had 40,000 minus 30,000 accumulated depreciation. We sold it for $50,000. Okay, this is going to make what we just talked about a little bit different. So we paid $40,000. At the sale date, it was worth $10,000. We sold for $50,000. So our gain would have been, the easy part is this right here. We can see that's easy, right? Because we paid 40, we know we got 50, so we know that's easy. The part that you have to make sure that you remember is, if we got $50,000, that means that we got up to $10,000. Then we got an additional $30,000. And then we got this amount here. So the other part of that 40 was the 30,000. Okay, so you see how we got all the way up there? Just another view of how you could look at that previous one. So that's how we got our $40,000. I could have done a better job right here. Okay. All right. Give me a thumbs up if we can keep going there. Good deal. All right, let's look at some problems there. Anybody do anything that you had a question about at first, or that you want me to go over before I select some? If there's something that comes up, just kind of let me know, and we can switch over to your problem right after that, okay? Let's look at BE, brief exercise 9.3. BE, brief exercise 9.3. How do we account for different things that we do, okay? Here's the first thing, or not, let's not say the first thing. As we talked about, we have asset, for lack of a better word, stuff, because I don't want to confuse you by putting expense. We have asset stuff, and we have expenses, okay? Asset stuff, okay? If I say asset expenses, that could be confusing, okay? So this here is stuff related to stuff that extends the life. Stuff that extends the life. This stuff has to do with general maintenance, okay? So, if you look at this problem here, we have a situation where a company has two transactions related to a delivery truck. They paid $40 for an oil change. They also paid $463 to have some shelves put in there. You may think of it as maybe the person that comes and delivers your Amazon order. You can get your own Amazon truck now, and you may have these shelves in the back, and you might have worn them out, so now it's time to get some new shelves in there. So just kind of think of that, what this could possibly be right here. This truck here, on the same day, it got an oil change, and it got some shelves put in. Think for a second, and I want you to tell me in a second, which one would be the asset, the other stuff? Would it be the shelves, or would it be the oil change? Think for a second. The shelves, okay? So the shelves are going to go over here. Why? Because and I use that term loosely, extend the life, but think about it. If your truck, now, not my truck, but if your Amazon truck doesn't have shelves, how are you going to do the deliveries? You have to organize that stuff in a certain way, and be able to get to it efficiently to make all your routes and stuff. So that is imperative and important that you have that. So the shelves are extending the life of the truck for what you're using it for, right? Which one is going to do, well, the other one has to do with general maintenance, just a regular oil change, okay? So, if it extends the life, then debit the asset. Why? Because the asset represents the life, or how much life that truck has, okay? So we're going to debit the asset. If it is a general expense, then I want to debit an expense account, okay? Everybody good with that part? Which, this right here, the asset stuff, the stuff that extends the life. In this example, shells for our truck is going to be here. If it extends the life of the truck, then we're going to debit the asset account, okay? On the other hand, if we have an expense, something that's general maintenance, okay? You do it every so often, you do it periodically. That's the way you can think of that. You don't get those shells every day or every week. If you're getting every week, then you probably got some cheap shells, okay? We don't want that because that's just more time it takes. You're going to get something more permanent, okay? So this is more permanent in nature. This is something that repeats over and over and over and over again, all right? So that's another way to look at it. We're going to pay cash for each of these items. So at the very least, both journal entries are going to consist of a credit to what? Cash. So we got that part right. This is going to be a credit to cash. The oil change is $40. And the cost of the shelving units is $463. Do not be fooled by the amount that you pay for something. So just kind of remember that, okay? I know that in most cases that, the assets are going to be a little bit higher, but always make sure we understand the character of what's going on. If it's going to repeat, then it's probably going to be a general maintenance account. If it's more of a one-time thing, then we're going to have an asset. Now remember, you may have to replace the shelves every year due to wear and tear of heavier items than you expected, okay? That's still more of a one-time thing. It's not something you're expecting to do unless it's part of just, general maintenance. And if it becomes part of general maintenance, then you start putting it over here and you start putting it over here. Why is it important? Because I need to see, this is going to affect my income taxes, right? So I need to know what's going over here. Now, I've already said, asset is the stuff that extends the life. If it extends the life, then I'm going to debit an asset account. Since we're talking about truck, let's just go ahead and debit property, plant, equipment, truck. Now, your answers in your book are going to call it something a little bit different, but it's going to be an asset that is there. In particular, either property, plant, equipment, or the actual asset name. It could be equipment, okay? If it is an expense, then we're going to debit an expense account. And since it's maintenance, we always usually use the term that is related to. So maintenance expense is what we'll have for $40. Once again, I know that this is a little bit cheaper, but don't always think that the value is going to dictate whether it is what it is. It probably will have something to do with it, but doesn't necessarily mean it's always that way. All right. So any questions about that concept right there? Take a second. All right, let's look at something else here. All right.
Is cash normally going to be the credited area since both of these are technically labeled as assets?
It is going to be the credit area. I'm not going to say exactly because it's an asset, because right here we're dealing with the income statement account. So I can't say because it's an asset, but I can always say because we paid cash. Or we could have put it on our credit card. So that would have been accounts payable now. No, now, going back to what we talked about previously, it's an accounts payable to us, but to the credit card company, it would be an accounts receivable. So just think about that from that term, because when we get to liabilities, it's going to kind of do something a little bit different as well. But yes, we'll always credit cash, but I can't just say because it's an asset, because it can be an expense like that right there, okay?
I accidentally said it wrong. I was saying from the beginning, you had the assets where the plus sign was on the debit, the account receivable was on the debit, and then the PPE was on the debit. And I'm assuming the expense is a part of the PPE.
Related to that, yes, it's related to that, because we're talking about an oil change that was on that same vehicle. So yes, it is related. In our personal books, we would have better notation, something a little bit more know, that we can kind of go into a little bit more in depth, but only for these right here, they just kind of give you general things that you have, okay? All right, let's go to a slightly different section right here. Let's look at BE, brief exercise 9.2. BE, brief exercise 9.2. We're going to kind of stay with this same concept, so I'm going to leave that up top that I had. I'm just going to erase this small section right here. To me, we've gotten the harder part out of the way. Part A of the harder part. This is also possibly the harder part, but it's not as in depth, okay? If we look at BE, brief exercise 9.2. BE, brief exercise 9.2. You have a company that has the following expenses. They're going to list some expenses for purchasing a truck, okay? So this is everything that went into you purchasing your truck. Yeah. Make sure we don't confuse these here. We have a truck of I'm going to write these down. Let's see here, because we don't need a lot of space. The total cost is $31,810, okay? The total cost is $31,810, all right? Now, before we get started, let's just kind of show an example of what we're talking about. You have a car, right? You have a vehicle, and you get a tag every year. We agree on that, right? That's true. Now, that tag money goes directly to wherever county or state or city you're from, okay? That's where that always goes. A part of this, let me see if it's in here. It's not in this example, but no, yes, yeah, it is in this example. That's your motor vehicle license. This represents the motor vehicle license. So even though you're paying all that money to the car dealership, you're paying a part of your tag cost that's in there, okay? Now, I'm just saying that is in there. It's going to come up in just a second, but a part that's in there, and that's going to help us understand the difference between stuff versus, as I call it, general maintenance, okay? So let's see. What all made that up? We paid cash for the truck of $28,000. Cash of $28,000. We paid sales taxes of $1,260. $1,260. We paid for the license plate, $530. It doesn't mean anything because I'm right on the other side. Just going to kind of keep it up a little bit there. And we also paid to have our company logo put on, okay? Of $2,550, okay? And that covers everything. Now, our job is to know or to understand what makes up the cost of the truck, okay? Remember, previously we had our balance sheet, assets, current assets, then we had long-term liabilities. One of them was property, plant, and equipment, and we had equipment of a truck. How much of this is going to go into the cost of the truck that I put in property, plant, and equipment? Let's think about it in terms of stuff that extends the life, and obviously the truck, for example, extends life, but more permanent things, let's say more permanent things versus more recurring things, okay? So let's think of that terminology here. I'm going to put in parentheses more permanent because that could be relative, but more permanent versus more recurring.
In terms of license, is that your personal license or is there a specific license?
Yeah, that thing is that on that metal plate on the back of the tag, that's that part. Yeah, that used to throw me off too. It's not this one right here. It's that, yeah, the license plate. The license plate, yeah. That used to throw me off a lot. This is talking about the license plate, the license plate, okay? Yeah, that used to throw me off a lot as well. That's correct, okay?
And what's under that? The logo?
This is the logo. We call it here painting and lettering. Logo, painting, lettering, stuff like that, designs, little stripes and stuff on your car, whatever that may be. We want to know how much the truck is worth, okay? How much is the truck worth? To do that, we must decide which of these is more permanent to the asset. Is the truck permanent to the asset? It is the asset. That's the one that we're thinking about. So this one here, we're going to include this one, okay? Now, what about our logo? Our logo, what about that? Is that logo gonna come off tomorrow? It might, and I'm gonna get a refund if it does. So people don't want to keep on giving me refunds, so we're gonna say that thing's gonna be a permanent part. If you think of it like, maybe what you're thinking like is, you see the people who have the vehicles, they have a big old company logo over the whole vehicle. That's more permanent. Yes, it can come off, gonna be a little bit cost of work to come off, but that's more permanent. Even if you see the people with on the driver's side, they have that big old sign, we consider it to be more permanent, okay? So that's why I say, in parentheses, more permanent, because it's going to be more likely not, it's going to stay there a lot longer. So with that, understanding that will not come off anytime soon, under normal conditions, is that going to be a cost of the truck? Okay? We agree. I agree with you. It's not going to come off anytime soon. I would not be happy to have to go back and keep on paying for that weekly or monthly, not even yearly, okay? Because was it $2,500? No, I don't want to pay that every time, okay? Now, let's do this. Let's do this right here. We have one that I did not put up there was insurance. I should have put it up there. I'm sorry. Let me put it up there. Insurance, okay? Because that's important. Insurance expense $2,360. Now that's important. Without your insurance, some bad things can happen. It's important for that vehicle. So, is it going to be a permanent cost because I'm going to pay it the rest of my time I have it? Is it a permanent cost or is it a general maintenance expense? Keep it in mind that I'm going to pay that. I'm going to always have it as long as I have the life of the truck. I'm going to always have it. Is it permanent? What you got? Why is that? That's something I have to keep paying. I know I oversold it on purpose. I oversold it on purpose. I kept talking about how I'm going to have it forever. It's going to be there as long as the truck is there. That's me leading you the wrong way. That's what a trick question does. It just emphasizes that one thing over and over again. No, even though I will pay it over the life that if I had it, my car is not here today. I got my car in 1995. No, 1999. Right? I paid insurance for 25 consecutive years. That's still a general maintenance expense. That's still something that is more recurring in nature than anything else. So we can agree, I've paid that stuff for the life of the car, right? I don't even know. Let's just say, I don't know, $100, obviously it's more than $100, but if you take $1,200, let's just say it's 10 months in a year, that's for a year. If you put it for 10 years, that's $12,000. If you do it for another 10 years, that's $12,000. Plus, I could have bought a new car by now. A new one of those cars. That's a lot of money, but it's recurring. It was $100 every month for 12 months. You see what I'm saying? So no matter how much the question sells you that way, is it recurring? Is it something that's general maintenance? Will I do this over and over again? Yes, I will pay this over and over again, which means that this insurance expense is not going to be a cost of the vehicle. Okay. Same for this building here. I don't know how much this building costs. It's high millions, but insurance is going to be on it. As you can tell, over time, you could possibly pay more in insurance than you can for this here. But it's still, because it's more recurring in nature, some things that we thought of more as general maintenance. Because of that, it will not be part of the asset, okay? Is everybody clear on that? Excellent, excellent work. Everybody clear on that? Okay? So always think about this. Read the questions, just don't get so wrapped up into it a lot of times, because that's what kind of throws us off, okay? All right, make sure I got everything. The cash price, I pay for that. I pay for the accident insurance. I pay for the vehicle. I pay for the lettering. What about the sales tax? That's going to go and be, I'll put this in there because the sales tax right here versus this fee right here. This is for your license plate that you'll continue to do over and over and over again. This tax is part of the vehicle, okay? Even though they're going to submit this to the authorities, that's how much the vehicle costs, okay? If you think about it, I don't know this because I don't work in a car dealership, but I would bet you if the car costs $20,000, this is my opinion now. If I say you something $20,000 and I know I'm gonna have to pay $2,000 in taxes, I'm gonna charge you $2,200 to make sure that I got the cost of that. So that's just another way to think of it. This could have been included in your price because they're going to pay it anyway, so make sure they get their full return. But regardless, this is a cost of the actual truck. It's a cost of the actual asset. Why? Because it is not recurring in nature. This is a one-time fee. It's not a general maintenance. That's out the way. Is it permanent? Because yes, it's permanently attached to here. Not like this not like this insurance expense, because the insurance is permanently attached, but but it is recurring. So since it's recurring, it will not be a part of that. Okay. So our price of our car is going to include the cash we paid for it, the tax we paid for it, the license, okay, that we paid for it, okay? The license that we paid for it. It will not, excuse me, I apologize. I just said that. It's going to include the cash, it's going to include the taxes, and it's going to include that permanent logo. Why? Because I don't want to have to keep on paying for that logo over and over again. If I keep paying for it over and over again, it would be recurring, and I just wouldn't even worry about it, okay? So I have these three that are going to be part of my cost, okay? So now, what should I do? That should make the total cost of my car how much? $28,000 plus this will give me what? $28,000 plus $1,260 plus $2,520 will give me say again? 31,810. That is correct, okay? 31,810. I'm going to debit and credit $31,810. I paid cash. We considerably paid cash for everything, so now I'm going to credit cash for that amount. What do I debit? An asset account, right? In this case, once again, we look at the same thing, the property and equipment for a truck. Okay? Everybody good in that part right there. In general, they're not going to ask you anything different than that. And there may be something else, but in general, that's all your choices you're pretty much going to get in terms of that. Okay? Everybody good so far? Okay. Now, let's begin one concept that we'll pick up next time. This amount right here, this is the amount I will depreciate. Okay? So whatever the cost is, that's what we depreciate. That's another reason, for every reason it's important, but this is another reason why I have to have the amount that's in here. Okay? That's the cost. That's the cost I appreciate. I'm also going to put something else in here, okay? Because this same concept, when you look at some examples of buildings, you're going to see different scenarios there. But when you come to whatever number that is for your building, that's the amount that you would depreciate. So we go to that part, because I have to make one thing that's very important. If you buy a house, how much the house going to cost? Let me put it like this. When you look on Zillow, the price for your house will say, I'm specifically saying, I'm trying to tell you what I'm saying. When you look on Zillow, the place and everything where you are that you will live will cost how much? Give me any number you want to. $300,000, okay? $300,000 for where you will live. You're going to have on there a house of some sort, and you're definitely going to have that house on land. That's why I say on everything that I have, okay? Because I want to be very vague in order to get down to this right here. Whatever it takes to get to the cost of that house, great. You're going to either, I don't care if you pay this cash or overtime with interest. You pay $300,000, that's no problem. Our focus is going to be on next time, how much of that do I depreciate? How much of that do I depreciate? On your books, you're going to pay, you're going to have PPE, $300,000, and cash, $300,000 or some type of payable. That's what you're going to have on your book. How much of that can you depreciate? And by the way, this is not your personal house. This may be a rental house. I should have said that at first, because you can't depreciate, you can't do anything depreciation-wise with your regular house, okay? But in terms of if you're buying this house as a vacation house that you rent out or something, some of that can be depreciated. What I want us to know is that I don't know what this is. You have to go and to look this up wherever you are, because where you're going to buy your $300,000 vacation house that you're going to rent out is going to be a different location, which means prices are different, right? But y'all going to both pay $300,000. This component right here, land will never depreciate. Okay? Land will never depreciate. So what you're going to have to do is to break down the cost between, and that's why I have to make sure I say it as vague as possible, wherever you live, including the house, the land, everything on there. You're going to have to break that out, because you never depreciate land. Depreciation, as we'll find out next time, is more so of an allocation method. It allocates the cost of an asset over the income statement over a certain period of time. It has nothing to do with the value part. No, that's why I said I was only using the word value just in terms of what we're talking about, but it's not that it doesn't have a value. It's not even, once again, that the value of a vehicle goes down. Those at the antique show, those old vehicles, those values are probably worth more now than they were then. So it's not about the value, right? It's about allocations, about the allocated over a certain period of time. Land will never be allocated over a certain period of time. Land will never be depreciated. So if you see some lump thing, which you're going to see when we talk about that next time, you're going to be given a building. You're going to be given a building with, say someone buys all this space here, and they want to make a parking lot. Well, there's going to be a cost to tear down all this stuff. Then you're possibly going to get something back out of all that. How does all that compute? How does all that go into your total price of your asset? That's what we're going to look at next time, okay?